Let's just start with that one theme and then we can move things along a little bit. High debt, low growth. What are the companies that do well in that world?
Well, in many ways, John, I think this is a bit of a continuation of what we've seen in the last cycle. You know, if you think about the last cycle, which was the longest bull market we've seen in over a century, and at least in the US, the longest economic expansion for pretty much 150 years, it was characterized by growth performing better than value, and in particular technology outperforming, and as a consequence of that, the US outperforming because it has a lot of exposure there. But the main reason that happened is because growth was relatively weak over the last 10 years, and alongside that we had continually falling interest rates until they reached record low levels, and that really boosted the preference for long-duration growth stocks. Now, to your point, John, as we come into the next cycle, the very high debt levels, particularly for governments, probably mean lower long-term nominal growth, and alongside that, commitments to, again, have extremely low interest rates. So the same kind of flavor of companies, I think, will work. People will still pay a preference or pay a premium to get access to growth, to companies that can continue to pay dividends. And in particular, and perhaps this is one thing that is different to the last cycle, high debt levels mean a real preference for companies with strong balance sheets and more flexibility.
Typically, Peter, that's going to take me to large mega cap tech firms, and typically that's going to take me to America. And one thing that you've provided a little bit of clarity on over the last couple of weeks that I find interesting is that we don't just have to look to the United States for this kind of story, because I typically look to Europe and say, well, there's an implicit bet in there, and it's not tech. I don't see the tech in Europe. I see a lot of healthcare. I see a lot of banks. Are you saying that I can get a similar story through a European index, Peter?
You can. I think it's quite interesting that that theme that we've just discussed has played out in various different forms across most markets. Of course, the US has a particularly high concentration in technology, about 25% of the index, and the top 5 companies, which are all technology or technology platforms, make up 20% of the index, and Europe doesn't have that. But amazingly, the technology sector in Europe itself is now bigger than the oil sector, and it's close to the size of the bank sector. But the 10 biggest companies, you know, just 20 years ago were all technology and oil names and a bank. And now none of them are banks, oil companies, or telecoms. They're mainly strong balance sheet, stable growth companies, which we call the granolas, and that mnemonic reflects the names of those leading companies. And the 11 companies that we have in mind here, you know, made up about 10% of the market a decade ago. Now they make up a quarter of the index. And again, I think they're liked because they have relatively predictable cash flows, strong balance sheets, and they have a dividend yield which is still way higher than they're paying for their debt, to your earlier story, John.